Hey traders, Stephen Kwitzel here with TradersPlanning.com. It is Thursday, June the 14th. Wow, it's the summer is really starting, getting close to 4th of July. I hope everybody has a wonderful summer with all their trips and their family, because that's really why we do this, and that's really what's important in life. The stock market just keeps us busy and allows us to fund those fun activities. So I want to go over a lot today. As usual, I want to go over the market breadth. We're going to look at some breadth of some individual industries to show what's really pushing up the market. The dollar is incredibly strong right now, and I really want to look at cross-reference the dollar with some emerging markets and why I think emerging markets, even though I like them long-term, but I'll change my mind, and they're looking incredibly vulnerable. So we're going to look at a lot of those charts just to see what the leaders are and what the laggards are, to make sure that you're not positioned long-term for something that's going to underperform over the next 12 to 24 months. So I got you covered. So real quick, let's make the lawyers happy, and let's just read a quick disclosure right there. Okay, let's get rid of that. So let's just start here. We're headed into the close on Thursday. The Dow has been weaker than the other remaining indices. The Nasdaq has just, the Nasdaq and Nasdaq 100 tech has been leading, and we're going to talk more about that here in a minute. But if we look over here at the top 10 movers in the Nasdaq, Etsy and Dropbox are really pushing up the Nasdaq. I wonder if there's are really pushing up. Got in IQ. So got some really big leaders, but there is clearly tech continues to push the market higher in this bull market, not just this year, the QQQs, but I'm talking over the last 2 years, and that's a good sign, right? And I think that will, I think there's going to be some corrections, there's going to be some pauses, but I can't imagine in the world that we're living in where technology will not continue to be a leading sector most of the times. Doesn't mean all the time, but there's a lot of growth from technology, sales growth, earnings growth. It still is a baby sector, and we haven't even scratched the surface. So let's go look at some individual charts, the Nasdaq, the S&P 500, and then we'll kind of go through some things. So I want to start with the Nasdaq. It hasn't stopped. It's funny because you have, and I feel like some of the easiest webinars are the ones where the market goes straight up. So some of the most boring, in my opinion. But to me, and as I've showed in the past, we're looking at the green line. We're looking at, and we're going to stay in the market. We're looking at the rally coming out of a correction. This is a nasty correction. Well, no correction is pretty, but this is a nasty correction, and trends coming out of corrections are very strong because people, they're wore out, they're bearish, they think the market's going to crack wide open, we're going to have another 2008, then boom. So we broke out of the bear flag, and since we broke out of this bear flag in the Nasdaq, it hasn't even broke the 5-day EMA. That's pretty strong. Now, I say that to keep in mind, we are pretty far above that 50-day moving average, which we're going to look at here in a second. And typically, just from light studies, I've seen that when the market, even in bull markets, get above 4-5% above the 50-day or the 10-week moving average, a lot of times it'll ease a little bit. It doesn't mean that the bull market is over by any means, but it'll just kind of pull in, take a pause. So it's pretty frothy right here. So just kind of keep that in mind. And me, for the most part, I'm paying to the individual stocks. I do have leverage ETF in my trading system, and I can stay in that until it breaks the 20-day moving average. That's in the members area for the members that are listening. But right now, it's just strong, and it's hard to argue with it. And let me pull, just to kind of prove, go a little bit more over the Nasdaq, just to kind of look at the long-term picture. Let me stretch this chart right here. So let's look at the weekly chart. Why not? Okay. This goes all the way back to 2010. So let's talk about this 2011 correction, because this was a pretty good correction. S&P got downgraded. I was a financial advisor. This is a very good correction. It kept chopping around. We had a nice trend, right? And it kind of zigzagged its way higher, and then 2013 was the year that it just would not go down. Every time a pullback happened to 3 to 5%, it just continued to charge. I mean, this was just a major move. And then it really kind of grinded its way higher. My point is, look at it coming out of this correction right here in 2015, 2016. I mean, that's serious. I mean, that is a serious trend that lasted from July of 2016 to January of 2018. So what are we looking at? A year and a half of I mean, there was no correction. No 10+% moves to the downside. Not even close. And then we have our correction, and now we're coming out again. So coming out of these corrections, sometimes you can have a shakeout like you did right here. Like you think you're all hunky-dory, and then shake out, and then boom, it starts. Well, same thing right here. Coming out of the correction, shake out, boom, it starts. So my point is, I mean, this right here, this is a multi-month run, and then it does two nice pullbacks, and then it has this monster run, okay? So we're coming out, and if you look at these trends coming out of corrections, look how long they are. And I don't know if it's going to be that long, but coming out of the last two corrections, they sure did run a while. And maybe we get, some of these in here, some of these nice pullbacks, these 7 to 9, 10% pullbacks, which is healthy. You don't want it to go straight up. My point is that trends coming out of corrections can be incredibly long in the tooth. So don't get too fixated on valuations or anything like that. If you have a stock and it's working, my recommendation is to stay with it as long as it's working. And when do you know when it's not working? I just use simple moving average rules, right? You have a quick sell half at 10%, raise your stop to break even, let the rest run until it breaks the 50-day moving average. That way, and most of them won't run. Most of them will continue to chop around, but maybe 1 out of 4, 1 out of 5 are going to run, and it's going to be a really nice run, and that's going to allow you to outperform. So just keep that in mind. So while I'm talking about valuations, I want to go ahead and bring this chart over that I found. Let's go to the table real quick. So this is just the S&P 500 PE chart. Excuse me. Okay, so actually I do want to go back to the chart. So let's look at historically speaking. Now this is trailing PE, and I don't like to look at trailing PE. I like to look at forward PE because I don't really give two hoots what happened 12 months ago. I care about what's going to projected to happen in the next 12 months, but it's just a decent chart to look at. So this goes all the way back to 1870, just to kind of show you where we're at in these cycles as far as historical trailing valuations. And I think it's very safe to say that we're up there. Across this level, basically across the last century until we got to 1990, and then valuations started to spike. Now, I make 0 decisions off a PE ratio. I don't care if it's 500 PE ratio or a 5 PE ratio. Typically, if it's 5, I wonder why it's 5. But my point is just to go to show you, we have been trending above average since 2010. It's 2018. So markets can stay stretched for years, and they can be under stretched, or let's say just oversold to the downside for years. So it's important. This is kind of trend following. It's important to stay with the trend because you don't know how far the trend will last, right? And if you don't know how far the trend will last, just use simple moving averages. They're incredibly simple. Use, trend lines, whatever you have to use, to let you know that, something is changing. And then you can just get out and let it roll over. But my point is, don't make decisions off PE because this has been riding upwards for several years now, more than a decade. Okay? Let's move this as well. Oh, one more thing I wanted to add here. So I know I've showed you that the market can get, right now I've just given the good old eye test. I try to find points going back in the last decade or so where it seems like the market is a little stretched above this 10-week, this orange line, and what happened afterwards. So typically when it gets above 5%, like you can see right here, above 5%, it pulled back. You know, if it gets above 5%, it eases a little bit. It was not 5% there. Looked above 5% there and it pulled back. It was 6% above the 10-week moving average and it pulled back. And right now we're at a little bit over 5%. So my point is, it's not something, again, I typically make trading decisions off of. It's just something to be aware. When the Nasdaq gets 5% above the 10-week moving average or 50-day, it's just a little stretch. So if you're looking to buy a retracement, sometimes it just makes sense to let it ease a few points before backing up the truck, as I like to say, and just buying as many shares as you want to. So right here, same chart with S&P 500 we showed last week. It broke out, came down, tested the trend line, and it's looking like it's just trying to ease a little bit. No big deal, but look at the distribution that's starting to come in a little bit. There's definitely there was some distribution yesterday, a distribution day, in above average volume. So, and a lot of times, pullbacks, eases doesn't mean it's coming straight back. It might just go sideways. My favorite is when it goes sideways and it lets these moving averages time to catch up. And then gives it a nice little kiss and then continues its uptrend. Like this right here, you're coming out of a pullback, shake out, kiss, 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 pull back under, and then it just continued to charge. Now this was just a strong trend. I'm not expecting this kind of trend because this is just amazing. But we've been playing this trend since right here, and we've done really, really well. So that's why you don't want to wait till you're all the way up here, or in the Nasdaq you'd be all the way up here. It's better, you'd have a better batting average if you just find a reasonable support zone and take a pilot position as it moves up, continue to add. As it finds support, continue to add. Next thing you know, you're fully invested. I'm pretty much fully invested right now. Maybe 75% in one account, fully invested in most of my accounts. So. Small caps, this is a weekly chart, but it looks like a stock. It looks like a stock to me. It looks like a steady Freddy stock just continues to just break out and it's just headed higher. And it has to do with the strong dollar. The strong dollar is going to correlate with the strong small caps. And we're going to look at that here in a second. The dollar rules everything in my opinion. Not everything rules the dollar. I think it starts with the dollar and just kind of works its way around. So let's go look at the US dollar for a minute, because that's going to be a basis for a lot of our conversations. So the dollar, instead of really kind of pulling back in retracement into this zone, which in this 92 zone of the dollar, it'd kind of be expected for a 50 to 38 to retracement. It doesn't look like that's happening because the dollar is up weekly, but if we go to the daily chart, the dollar's up almost 1% today. So there is some strength there, and that is putting downward pressure on emerging markets. Like the S&P 500 broke out relative to emerging markets. So if you have a choice, I have a portfolio I'm managing for a family member, and he had some emerging markets, and it's time to make the switch. It's clear as day that the relationship has changed, and with a strengthening dollar, you want to be underweight, emerging markets, international stocks. You want to be overweight U.S. and small caps, because the large caps are just smoking everything, and the small caps are smoking the large caps. So, and that's continuing to just put downward pressure on emerging markets. So, over the last couple of years, I've made some big cases for emerging markets and commodities. Commodities have done well, at least a couple months ago when the oil was starting to really move, and that was pushing up the CRB. Let's look at that here in a second. But it's pulling back a little bit right now. So let's look at the VIX real quick. I hadn't looked at that in a while. I don't make trading decisions off the VIX. It's more of just, one thing I've learned about the VIX is a lot of times when it makes an initial surge above 20 and it comes back down, typically that's just the beginning of the volatility. Come back down and ease, and then I'll take another thrust. So it's really the only thing I've learned from the VIX is that first 20 crossing, which is kind of my line in the sand. It's typically not the only crossing. There's another one coming pretty soon. But, I mean, it's hard to be bearish. Tech is leading and the VIX is at 12. I don't really worry until it gets above 18 or, you know, so everything's fine on that front. Let's look at some market breadth. Look at ADP. Actually, nope, that's not the one I want to look at. So you have the percentage of stocks above the 200-day moving average in the S&P 500 are at 66%. They're starting to curl down a little bit, even though the S&P is curling down a little. It seems like the breadth's curling down a little bit more. Tech is really moving the market, and it is moving the market in a big way. And I think there needs, even though there is broad participation, there's a difference between broad participation and broad really strong participation. I think the strong participation is coming from discretionary and the tech stocks. We'd really like to see some strong participation or at least some rotation into some of these others. I don't think it's really happened yet. I think it could. But right now breadth is good, but I always pay attention to when it goes back under 60%. Percentage of stocks above the 50 and the 20-day, I don't really pay attention to that because there's just too many signals. It's hard to get a read on it. I try to keep it simple as possible. Look at the bigger trend. So the high-low, let me try to, let me see if I can blow this up for you a little bit. The high-low percent of stocks in the, let's go all the way down here. So when it crosses above this 10 level, and this is something I got from Arthur, I believe Arthur Hill, a stock chart. Typically it's a breadth thrust, right? So you get cross that 10, it's a breadth thrust. And it doesn't get negated until it goes below 10, which is a bear thrust. So you start to, and this is just a good way to, you know, pay attention, kind of accumulation distribution type stuff. But you had that initial thrust in the Nasdaq 100, and then more high lows coming in, more highs coming in. Then you had small caps was second, then mid caps was third, and then S&P 500, a little bitty's fourth. So it just goes to show you that risk is on in the smaller caps and in the tech stocks more so than just in the big mega stocks right there. That's not what I wanted to go see. Let's just start with materials right here, and really, you know, I'm looking at the price action. It's broke out of the downtrend. It's broke out of the horizontal. It's coming back and testing this zone. You can see right here, if you play the RSI 5, when it gets oversold, overbought, and then comes down to oversold, a lot of times that'd be a good entry for a quick swing trade and then get out. But if we go down here and look at the breadth, you have pretty good breadth in the materials as far as percentage of materials above their 200-day moving average. So it's a decent chart, but I think we're going to find better. Energy to me looks like it's going to crack. And when I say crack, I know it's I know this is a bullish move right here. But I mean, I kind of look at this over here and I see shoulder, head, shoulder, and then a breakout. Then I see a shoulder, head, shoulder. I just think that this trend line right here, I could draw a trend line and it's just looking like it wants to break. Energy is strong. A lot of stocks coming in energy, but it just seems to me like it moved really, really quickly. It needs time to digest, so I think this trend line is going to break. Could be wrong, but it's looking like it wants to go. Financials have definitely been a disappointment, especially in rising interest rates. Have lagged completely. Haven't even broke out of the downtrend. Haven't broke out a horizontal. Could just undercut these and just take a leg lower. We sold our bank stocks today for a wash because they just weren't going anywhere for about 6 weeks, and there's just you sell the weakest ones. If you're in an uptrend, you want a diversified portfolio. But every now and then you gotta analyze and say, I'm gonna get rid of the bottom, 1 or 2 stocks. And that was it. They just weren't going anywhere. Weren't making any, weren't really losing any. There's pretty decent breadth, but again, it's just not the price action of the the financial ETF XLF I'm not digging it. It needs more time to consolidate. It needs to break out of a horizontal or a downtrend or something. But it's not leading. I think there's other areas of opportunity. Industrial definitely broke out of a downtrend right here. It's just kind of pinballing along. Doesn't really excite me. I think breadth for everything is okay right now, but let's look at something a little bit more exciting. Yay! Technology. 52-week high, all-time high. Doesn't look anything like the other charts. I mean, this is where you want to be at, in my opinion. Let's just say it pulls back into the 70 level. I would say that's an opportunity. Just like, if you're looking to play the overbought, oversold, you get into the oversold RSI, under 30, RSI 5, boom, there's an opportunity. And that's what I think. When you get the strong ETF, and you're looking for swing trades, I think just a simple coming out of a oversold 30, selling into an overbought over 70, I think it's just a good strategy for very short, small trades. Look at the breadth right here, 86%. XLP, consumer staples, starting to turn around. Breadth still sucks, but downtrend, bear market, death cross, everything, but now it's starting to do something different, okay? And I always like to try to get in early, but when I notice a personality change, I start to pay attention. This is too early to say that consumer staples is a personality change, but it did finally break through that 50-day moving average, and it's trading sideways. So something worth keeping an eye on. Utilities are leading today, which is not something you want to see, but I guess it's got to lead sometime. But it's still in a bear market. You have the 50 days under the 200-day. There's no pattern whatsoever. I don't even know where I would enter this thing right now. Just looks like it, had a rising wedge, and then that trend line broke right here, and then it's coming back to test that trend line, getting slammed back down again. Breath is awful. Healthcare. Healthcare is looking like it's coming on late, and I like it. Broke out of a downtrend, broke out of horizontal, and is probably riding some type of 5-day moving average. So, I like it. I like it. There could be money rotating into healthcare. I think that there is. We'll look at that here in a minute. But look at the high-low percent. You can see spikes coming in. Good breadth. I think we still got to look at discretionary. Whoops. No, didn't want to go there. Yeah, discretionary is even stronger in tech right now. We might have to investigate that a little bit. But, man, this thing's going straight up. That's bullish. Discretionary items, things that people want, don't need. The kind of stocks that you want to own in a bull market. So you had a nice move, correction, breakout, and just gone straight up. I wouldn't buy here. I would wait for an oversold or a pullback into support zone. Maybe you play the RSI strategy a little bit, and that'd be a good trading plan. Breath looks positive. Let's go kind of do a sector summary. Yeah, Nasdaq's coming back. The Russell's kind of underperforming today. Let's just go look at the sector summary a little bit. Let's look at the last 5 days. Let's look at the underperformers: energy, financials, materials. None of them are doing well. Consumer staples are doing well, along with cyclicals. Interesting, because they're typically opposite, right? But you know, consumer stocks, whether it's staples, are kind of leading. Healthcare is up there. Utilities are up there. Technology is down. It's kind of surprising, but because it's up big today, it probably doesn't include. Yeah, that's through yesterday, so it would be up today. But still, consumer staples. You know, we looked at the chart a second ago. When you start to notice it across multiple platforms, you know, just start to pay attention. I think it's a little early still, but it could break out. It could build a flag and break out of it, and then you could get some nice price action in consumer staples. Right before the summer months makes sense. The summer, sell in May, go away, all that crap. I say crap because, you know, I like to follow the price action first, but people could be preparing for the seasonality of the market, and there's some truth to it. I'm not going to sell till it's time to sell. Let's look at, so let's go to some EEM. I want to look at some emerging markets right now and just kind of compare it to the SPY, the RJI index, the VEU. Okay. Okay, so what I like to do for long-term trends is I really like to look at, you know, have a look-back period of about a year, 252 trading days. And I like to have longer look-back periods. One, that way you're not over, you know, switching in and out. But it just goes to show you why I like 12 months. One, is proven through certain testing momentum strategies. But two, it really allows you to play longer term trend. And one thing I've noticed even at looking at this is if you're invested in a sector, some low cost ETFs, and you're just riding that for a while, let's say for a few years, you have a long term plan. When they outperform, when they take leadership, they can hold that leadership for years. Multiple years. The emerging markets took leadership from 2002 to 2007 and just left everything in the dust. Like it wasn't even close. Emerging markets versus S&P 500 for 5 years was not even close. So it pays to pay attention to these relationships or these relative charts to find out what is performing and what is trending. And yes, you're going to have some whipsaws, but just kind of understand where the leaders are. So let's look. So you have at the top the RJI, which is the Rogers Commodity Index ETF. That is the leader over the last 12 months. You can see it's coming down. It's coming down with oil. So is this going to hold for a long time? I don't know. But that's the beauty of it. If you have a rules-based system, you don't have to sit here and think. But what's interesting to me is international stocks, they are now at the bottom. That's the VEU, the All World ex-US Index. But what's also interesting to me, so that's at the bottom. So let's just get rid of this for a second. Let's kind of clean, no, not Visa. Let's just clean up this chart for a second. But what's interesting to me is you got the US as the blue chart, the S&P 500, and the emerging markets is the red chart, and commodities are way up here. The interesting part is the US just crossed emerging markets, meaning you have emerging markets that's been outperforming for 12 months, let's just say 11, and now all of a sudden S&P 500 is taking leadership over emerging markets. So what I did with the portfolio I manage is kind of switching out of emerging markets and going more US based. And a lot of this does have to do with the dollar all of a sudden getting real strong, and that's pushing down. But let's just take this out for a little bit longer and see what happens. So if I did 252, let's do 5, 4, all right, let's do 2 years. So if you look at 2 years, emerging markets have done well, have done the best, and commodities have done the least. So it's just interesting how these relationships change, and you don't have to overtrade them. But look, S&P 500 is starting to be strong, emerging markets starting to be weak. The one thing I have learned about emerging markets and commodities is they can underperform for years. So it's something that you really, really want to pay attention to, especially if you have long-term money in ETFs. It's in a swing trading situation. You know, most of us have IRAs, and I try to use some kind of momentum system with my wife. So, you know, I just leave that thing alone. But it's really interesting. And then if we go back, let's just look at, so this is EEM right here. This is the Mega Emerging Markets ETF, right? At least it's always the one I've known. I think VWO is the Vanguard one. Boy, this is looking like it wants to crack wide open to me. It surged really good. It never came back and broke out. When the S&P 500 came back and broke out, that's when the emerging markets started going down. And I could probably throw a dollar chart on here, and when the dollar started going up, actually, I kind of want to do that. Let's just get rid of all this. Solid thick line, price. I just want to see how it corresponds. Yeah, so right here, the blue line is the dollar right here, and it was already in a downtrend, but right here, when the dollar started getting strong, is when the S&P 500 started getting strong, and it continued its thresh down. So if you look at, all I'm saying is if you're looking at emerging markets, I've been incredibly bullish over the last 2 to 3 years you might want to be careful, because there is distribution. There's a lot more sellers than buyers, so it's something to pay attention to. If we continue to dive further into that, let's go look at some emerging markets. I have all kinds of ETFs and lists. What I like to do sometimes from an ETF standpoint, kind of from a trend following standpoint, as I do a 3-month relative strength scan, just to really see what the strongest stuff is, so I can try to catch it early in this move. So you have this, and these are about 44 just somewhat liquid ETFs. Some of them are emerging markets, individual countries, just a list that I've created. So if you look on the 3-month chart, only a handful of them, only 3 of them are above 70. Israel, Qatar, and this QUEB, this Chinese Internet Stock ETF, which is mostly a lot of U.S. listed ADR, so I don't even know if it should be in here. China small cap is grinding its way higher, but you know, on a 3-month, a lot of these are just looking awful. Turkey, I'm sure that chart looks awful. I know Brazil looks awful. Like they are just rolling over. And maybe it's an opportunity, not a threat. I don't know, but typically when I see something like this, when I see the death cross and I just see this, yeah, you could play for a bounce, but I mean, look at this. Look at these kind of downtrends and how many years it was. So if you're on a monthly chart and you're breaking that for the first time, I mean, let's just draw some lines on this. There's when it broke. There's when it broke. And then there's when it broke. So broke here, that sucked. Broke here, it just went in a downtrend for years and years, and now it's broke again. So I don't know if I'd look at it as an opportunity. I think I don't know. It looks like more downside. So I'm just looking at all of these, and you can see the death cross is happening on all of them. So all I'm saying is you definitely want to be extremely cautious on these and just pay attention. Maybe it's time to start thinking that emerging markets could have a bad year or longer. So, and maybe this is the bottom. Again, I'm not saying it is, but I'm just saying from historically speaking, it can be out of favor for a very, very long time. So, really just wanted to kind of pre-warn you on that. Let's go look at some charts. I'm just curious. Oh, Seiko. Okay. Let's look at gold right here. Gold kind of looks like it's trying to perk up, which is interesting because the dollar's perking up too. So you have GLD that is looking right here like it wants to kind of round around. You have GDX, which could break out of this little mini horizontal. Now, this could be one big, maybe it's an ascending triangle. I don't really know. It also could just be a wedge that could break kind of like this. But gold is looking interesting. It's looking like it's not really following the typical inverse relationship. The dollar down here is definitely rising and is rising nicely. So it's something that I'm watching, but it's still somewhere in no man's land, and it's been there for about 2 years. So I'm not going to get overly excited one way or the other on gold. Yeah, this is interesting because last week we looked at this chart and we were right around here, and I said, you know what? Typically, yes, you could call this a pullback in the zone, but typically when I see a waterfall, it doesn't come straight back. It needs more time, and then I was right because this week it's just totally breaking. And this just takes time to sometimes be able to recognize. You see gaps in gaps. It's not going to come back in some V-shaped recovery, typically. Typically, it needs at least more time to consolidate sideways, or just it might bounce and then just take another leg down, because that's some pretty heavy selling pressure, and you just have to keep that in mind. A lot of times, if a bunch of people are running for the door at the same time, they're not all going to get out at the same time. Some might get out a little bit, and then they wait, and then, wait for the traffic jam to slow down, and then they will hit the door again. And that's what it looks like it's happening with oil stocks right now. So right now, I'd be more of a bear than a bull, but I'm not either way. I'm more just thinking this is just going to be a heavy pullback, because you have this heavy uptrends, you have these heavy pullbacks. So we'll just see how it goes. So I hope this was helpful. Let me know if you have any questions.